Welcome back to the chapter 6, and I think we left at the special issue for step 4. And then the most important thing for the step 4 is to allocate the transaction price to the performance obligation, right? And then we said that the allocation itself is nothing difficult. What is the difficulty is to deciding the percentage of allocation. And then we say that there's a various approach that are available to estimating that standalone selling prices, because standalone prices is each standalone, if it's, you have a multiple performance obligation, each standing alone price of each obligation is going to be the denominator, and the obligation itself, the specific obligation itself, is going to be the numerator, right? Okay, so then the standalone selling prices is the key to understanding the allocation. So there's a couple of methods here. There's a first method is called the adjusted market assessment approach. So what this approach meant that you can find the standalone price, let's say finding in the market. So this is the most easiest one, right? So the market already told you how much it was, then they just added it up and dividing them. And then so second one is expected cost plus a margin. So this happens when you are not really sure the the market price, and then you just wanted to say, well, by performing each method, each obligation, how much that I can make on top of the cost. This is also simple, right? So then the standalone price is just the cost plus the percentage of the profit, right? So that one you can recognize as well. And the third one is called a residual approach. So basically you have a basket of price, right? The total transaction price, and some of this worth some money. So the leftover is gonna be the total minus the known part. So because the third method is pretty much that we don't quite know in the normal life, then that's why we're giving an example. For example, assume that TrueTech sells 1,000 tree boxes with 1 year of TreeNet subscription for $250, and the standalone selling price for TrueBox is actually $240. The standalone selling price of 1 year subscription is highly uncertain because TrueTech hasn't held that services in previous life and previous time and hasn't established price for it. So if we use the residual approach with the third approach, then it's easily just using the total price of 250 multiple 1,000 and minus the standalone price of known, right? We know this for 240. So then the estimated standalone price for the TrueNet subscription is $10,000. And so to journal it, then of course we're gonna debit the $250 as accounts receivable, and we're crediting the sales revenue for $240 because the tree box is actually delivered at a point of time. And then we're crediting the deferred revenue for $10,000 because this is the obligation to perform over time of period, right? So then we do the concept check. Allen Company wrote a contract that involved two separate performance obligations, and Allen cannot estimate the standalone selling prices for product A. However, product B has a standalone price of $200. The price of a combined product is $250. How much the transaction price would be allocated to performance obligation for delivering product A? So it's simply just gonna be $40, right? Because 240 minus 200 that is known, so the leftover $40. Okay, so special issues step 5 is actually a little bit more complicated than it's just simply to recognize it, because there's so many different forms of recognizing different kind of revenue, right? When each obligation is satisfied, but how do you identify the obligation is satisfied, right? Especially there's a lot of different kind of arrangements, such as we can first of all we want to talk about the license, and then franchises and bill and hold arrangement and consignment arrangements and gift cards. So in terms of license, there is a functional license and a symbolic license difference. So first of all, license means that allow customer to access the seller's intellectual property, right? So access someone's intellectual property is related to so first kind we call it the functional intellectual property. It means that the transfer a right of usage, and so sellers typically recognizing the revenue at the point of time. This kind of functional intellectual property has a significant standalone functionality. That's why it can be recognized at a point of time. For example, it means that it can perform a function or task or be played or aired, such as you download a music, right? You paid for a $15 album for someone you like from the Apple Store. So this download itself, it means that you access the singer's intellectual property, right? And but this download itself has already transferred the right of usage to you. You can start listening it already. And then this means that it has a significant standalone functionality. When you play it, you don't need the singer interfere or intervention to help you. And also the benefit of the customer received from the license isn't affected by the seller's ongoing activity. Means that the singer don't need to keep saying for you to listening his or her voices, right? So basically the access itself has been already completed. The enjoyment does not involving the sellers anymore. The seller's ongoing activity does not affect the customer's benefits. And at the same time, and then we view this transferring of rights to use. And then the revenue is recognized at that point in time that you download or paid for start using the IP, intellectual, right? And then there's another kind of intellectual property access right. It's called a symbolic intellectual property. What does that mean? It means to transfer seller's intellectual property with understanding that the seller will undertake ongoing activity. And then the benefit of a customer received from a license is affected by the ongoing activity. For example, therefore, the license transfer of a right of access to seller's intellectual property. So, for example, the logos and the brand names, because once you paid to using a brand name, the brand itself can change, right? Sometimes you thought this is a good brand, such as some expensive like a handbag, but the bag is not doing well, like a Coach, right? I mean, if you're a girl, you know that. So this brand name is very expensive. You can access it, right? But the operation and the involvement in the management making the Coach become a mess. It's a job from the luxury line to like everybody can have a Coach. So that means that the value itself is deteriorating. Or franchise rights, right? For example, you want to open a McDonald's, and the McDonald's actually give you the intellectual right to access their recipe and menu. However, McDonald's, this corporation, their operation, their advertisement campaign also influence your ability to make money, right? So this is called a symbolic intellectual property. And then symbolic intellectual property, we wanted to recognize the revenue over the license period. And then one exception, okay, here in terms of functional IP, which we recognize revenue at a point in time, is viewed as a transferring right of the access, is if both the seller is expected to change the functionality over time. Okay, if it is considered as a functional intellectual property, however, it will be recognized over time if the right of access is expected to change, such as software upgrade. So you know, when you buy the software, such as the antivirus software to protect your computer, you know that by the time that you start using the antivirus software, you are the seller itself should already, like say Norton, it's already recognized the revenue. That's nothing wrong with it. However, because Norton has updating their software, hence that you have to updating your software as well. The customer is required to use the updated version. Otherwise, there's no point. A lot of function is not gonna work. So this kind of functional IP need to be considered as recognizing over time. Okay. Okay. So let's look at an example. Zach developed a software that helps farmers to plow their fields in a manner that prevents the erosion and maximize effectiveness irrigation. The Sportlock paid a license fee of $60,000 for a copy of the software. Although Sportlock can use the software as long as they want, Zach expects Sportlock will use the software approximately 5 years. Zach does not anticipate any further interaction with the Sportlock following the transfer of the license. How much revenue, okay, how much revenue should Zach recognize in the first year of a contract, right? So this one is should be directly recognized the $60,000, which is the whole thing, right? Because it says Zach does not anticipate any further interaction with the Sportlock following the transfer of the license. So that means that it's like downloading a song. The Zach, the Sportlock himself, whatever he do has nothing to do with Zach once it's pay for the license, download the license, right? Okay. Okay, franchise, we kind of mentioned a little bit. What is a franchise? Franchise is an arrangement that the franchisor grants the franchisee the right to sell the franchisor's products and use its name for a specific period of time. So in other words, let's use the McDonald's example. I wanted to open a McDonald's on Market Street, okay? So in order to access the brand name, I have to pay McDonald's Corporation franchise fees, right? At the same time, this franchise often including the license to sell their burger, fries, to use the intellectual property because the menu itself and the machine that they designed to fry the fries, as well as the initial sale of the products and the services transfer. And then they also will train me how to decorate my store look like a McDonald's, and how to managing my employee, and how to build the software selling module, and how to serve the clients, right? So basically there is also at the start of the franchise as well as ongoing the support over the life of my franchise. Say I bought the license for 20 years, so they will teach me how to do it. First of all, they will help me set it up, and at the same time, they will allow me to use their brand name, and then they will teach me new product and old product and train my employees as well. So therefore, franchisor in this case is McDonald's must evaluate each part of their franchise agreement to identify performance obligation. In other words, McDonald's will find out there's multiple performance obligation. For example, the license itself is obligation, right? Deliver the license is obligation, and it will be recognized over a long time period, which is 20 years. And also training employees the service obligation, and sell me the fryers is another obligation. So there's multiple obligations associated with a franchise contract. Okay. And bill and hold. What is bill and hold? Bill and hold sale is arrangement where that a customer purchases goods but requests that the seller not ship the product until later date. So basically, you customer purchase of the goods already, but they said, well, you can deliver to me 1 year from now. Okay, since the customer does not have a physical possession of the asset until the seller has delivered it. So therefore, the transfer of control has not occurred. So the revenue typically should not be recognized until actual delivery to the customer occurs, right? Okay. And consignment arrangement usually using in art gallery, right? The art gallery would be the consignee, and consignor will be the artists. So basically, what is consignment? Consignment means that consignor, which is artist, physically transfer their products, which is the arts, the paintings, to other company, which is the art gallery. But the consignor retain the legal title, so the artists still remain the title for their paintings. But if a buyer is found, the consignee remits the selling prices less the commission approved expenses to the consignor. Say you will charging the customer, say $200 for this painting, and then there's gonna be $50 remit to the art gallery as the consignee commission, and then the $150 gonna be the artist revenue, right? If the consignee cannot find a buyer within agreed upon time, say that you have a show and then that a gallery allow you to display your painting for like half year, but within this half year no one buy your product, then the consignee returns the good to the artist, right? Given that the consignor retains the risks of the ownership, it postpones the revenue recognition until sale to the third party occurs. In other words, delivery the painting to the gallery does not constitute a sales until the buyer bought the painting is considered as a sales event. Okay, so let's check our understanding of consignment arrangement. Alex Gurin is an artist who sells his work under consignment. He displays his work in local barber shop, and the customer purchases his work there. And Gurin recently transferred a painting on a consignment to a local barber shop. After Gurin has transferred a painting to a barber shop, the painting should be counting the barber shop's inventory? No, should it be counting the Gurin's inventory until barber shop sells it, right? This is how we think about it. Okay. Okay, gift card. So gift cards in the financial accounting we have already talked a lot about. It's always been considered as deferred revenue when you sell the gift card itself, and then the revenue is recognized when the gift card is redeemed or the likelihood of redemption is remote. So let's so there's nothing complicated about it, right? Okay. So we're just gonna briefly talk about the financial statement presentation and disclosure of revenue items. So there's a related item, the things that related to revenue, okay, except that in the income statement you have a revenue recognized. You also wanted to recognize the accounts receivable related bad debt expenses, because when you debit accounts receivable, then you're gonna credit the revenue, right? This accounts receivable, remember in financial accounting, we always estimate the collectibleness of it, right? Okay. And then also the interest, the revenue and expenses. For example, if there is a considered financing arrangement of the sales, then you need to consider whether there is interest revenue or expenses associated with the revenue recognition. And on the balance sheet, next topic is we're gonna talk about the contract liability and contract asset. So now just give you a heads up that the sales, especially construction project, the revenue recognition over a period of time is associated with recognizing contract liability and contract asset. At the same time, we know that accounts receivable is also always associated with the revenue landing on the asset side of balance sheet. In terms of the disclosure notes, I wanted to emphasize that we have to disclose the nature, amount, timing, and uncertainty of revenue and cash flows. And also the outstanding performance obligation, we have to discuss how the performance obligation typically are satisfied, right? And describes the important contractual provision like payment terms and policies and refunds and returns and warranties. So I'm not gonna be detailing to summarize all this, knowledge knowledge contents category. But what I want to say is that in past lecture and until now, we have talked about a lot of fundamental and special issue related recognition of the revenue. And then first of all, the recognition revenues has 5 steps, right? And then there's a lot of complication in each steps. The step 1 is called identify the contract, and then the fundamental issue is that a contract establishes the legal rights and obligation for seller and the customer with respect to one or more performance obligation. And the complication issue is that we need to consider the contract exists if it has commercial substance, has been approved by both parties, and specify the seller's and the customer's rights and obligation, and also specify the payment terms, and it's probable that the seller will collecting the amount entitled to receive, right? And the contract does not exist if neither of the seller nor the customer has performed any obligation under the contract, or both the seller and the customer can terminate the contract without penalty. And step 2 is identify performance obligation. It means that a performance obligation is a promise to transfer the goods and services that is distinct or identifiable distinct, which is the case that if the goods and services both are capable for distinct or separately identifiable. And then what cannot be considered as qualified for performance obligation? First of all, the quality assurance warranties, right? So basically this kind of warranty is only to promise the customer that the delivered goods are satisfied with as the quality that was promised to be realized as a normal course of the quality, right? Has nothing improvement or enhancement of quality on it. And also the customer's prepayment is not able to considered as obligation, okay? But what do qualifies as a personal performance obligation is, first of all, extended warranty. It's a warranty that warrants the quality beyond the normal course of action. And the second one is a customer's option for additional goods. Remember, we did a lot of exercise on the coupon exercise and the discount exercise. This is some sort of like the arrangement that allow the customer to enjoy certain benefits, right? So and it's totally optionable, and then especially the additional goods and services can provide material rights. That's when we have to identify the performance obligation. Okay, and the step 3 is pretty complex, right? And then we say that determining the transaction price, there's so many scenarios. First scenario is a variable consideration, and also we need to consider the constraint of variable consideration. And then we wanted to identify who is the seller and who is the agent, and we don't want to commingle that. And also there's a significant financing component related to prepayment and subsequent payment. If the payments and the selling point is the time gap is more than 1 year. And there's also, we have to consider the seller rebate the customer, there's any payment from seller to the customer. And step 4, the most difficult one, is trying to figure out the standalone percentage, and then to allocating the transaction price to performance obligation based on the relative standalone selling price of the goods and services, each obligation, right? And then we say we have 3 methods: market risk assessment method, and the expected cost plus margin method, and the residual method. Okay, so I believe the chapter C could be considered as most difficult part of the chapter, and but I wanted to tell you that it's nothing that you will not understand. There's nothing hard about it. It's considered at a glance, it's difficult. It is difficult, but I'm sure you guys can grasp it very good. Okay, so first of all, the part C is designated to talk about a long-term contract. Okay, long-term contract, when you think about this name, of course it's gonna be complicated because it's involve multiple periods, right? When you involve multiple periods, the two things you have to consider: am I recognizing the revenue along the way, along the time that I was conducting this contracts, or upon the completion? So there's a two-way that you can recognize revenue in terms of long-term contract. One is that you recognizing the revenue over the period. That's okay. Let's say I performed 30%. I recognize 30% of a contract revenue. Another way is that, well, let me do all of them, then I recognize my revenue. It's up to the seller, okay? But either one of these methods, you have to, first of all, identify the performance obligation. And it's pretty difficult to do that. Second of all, second thing is that recognizing revenue when each performance obligation is satisfied. Why is it so difficult about this two steps? Because, okay, it's because the performance obligation related to long-term contract is not very easy to distinct. Okay, like here said, usually have a single performance obligation because don't meet the separately identifiable criteria necessary for the good services to be viewed as distinct, right? Because you can hardly to find out which action I'm doing is considered as distinct obligation. Hence, a long-term contract has a hard time to identify performance obligations. And then because it's hard to identify performance obligation, it's hard to find out how to recognize those obligations, right? So therefore, recognizing revenue over time according to the progress of the completion is the method or principle that we're going to use to recognize the long-term contract. So the long-term contract often qualifies to recognize revenue over time according to the progress towards completion. And we want to recognize revenue of the either do this way or recognize the revenue upon completion. Okay. So I want you to memorize the number of this example because it's really helpful to remember it. It's associated with a lot of calculation and explanation later. So this slide is very important. You needed to have a photo picture in your memory or print it out when you listen to this lecture. Okay, so let's go ahead. At the beginning of the 2021, the Harding Construction receives a contract to build an office building for $5 million. Okay, $5 million in this case is the transaction price, which is the total amount of a Harding Construction company expected to receive, right? They are entitled to receive if they finish building this office. The Harding will construct the building according to specific specification provided by buyer. Okay, and the project is estimated to take 3 years to complete. According to the contract, Harding will bill the buyer in installment way over the construction period according to a pre-arranged schedule. Information related to the contract as follows. So first of all, it's a $5 million of contract, and the Harding will bill the buyer, as installment and periodically, right? So let's look at this. In 2021, the construction costs, this is actual construction cost during the year, is $1.5 million. Year 2 is $1 million. Year 3 is $1.6 million. And the construction costs incurred in prior year for the first year is 0. For the previous year is 1.5. So this number is right here. And then okay, so for the third number here, look, construction costs incurred in prior year for the third year should be year 1 plus year 2, which is 2.5 million. Okay, so therefore the cumulative actual construction cost for year 1 is 1.5 million, for year 2 is 2.5 million, for year 3 is 4.1 million. At this point, we know that this Harding company, if they expected the transaction price of $5 million, so their profit is $900,000, right? Because 5 million minus 4.1 million is equals to $900,000, right? Okay. And then, so this is interesting. So at the end of the year one, the Harding company saying that they expected the cost to complete this project is 2.25 million. By year two, they reestimate again. They said the estimated cost to complete is 1.5 million. And by year three, of course, you finish the project, the estimated cost is 0. So at the end of each year, the total estimated and actual construction cost for year one is 3.75 million, and year two is 4 million, and year three is 4.1 million, right? And then due to the arrangement, the Harding is billing the client 1.2 million in the first year, 2 million second year, and 1.8 million the third year. The cash collected for the yearly is 1 million for the first year, 1.4 million second year, and 2.6 million third year. Okay, so the journal entry regarding the costs will by first of all debiting the construction in progress. This is account we call CIP. It's like an asset account that recording the progress of the construction. It's a new account name called CIP. Okay, we debit CIP for $1.5 million, which is the actual cost for the first year, and the 1 million for the year two, and 1.6 for year three, right? So this is the first line number. Okay, and what are we crediting? Of course, we are spending on materials, cash, credit either cash or material or inventory, right? Then the adding of 1.5, 1.1 million, and 1.6 million. This is how we're recording the cost. And how do we recording the billing? We bill the client, as you see. First year is 1.2 million, and second year is 2 million, and third year is 1.8 million. So therefore, we debit accounts receivable when we bill them, and we credit a new account called billing on construction contract for 1.2 in year one, and we debit 2 million in year two, credit 2, and then 1.8, right? So this is a new account called billing on construction and debit accounts receivable. And how do we record the cash collection? Very easy, same as euro. So we debit the cash and we credit accounts receivable. So year one we receive 1 million, year two we receive 1.4 million, year three we receive 1.6 million. Okay, 2.6 million. So this is nothing different, right? Okay. So let's look at revenue recognition, which is what number can be landed on income statement. So in the year one, if there's a two method based on recognition revenue, if we are up on the completion, means that we don't recognize any revenue along the way that we produce this building. All we need to do is by the end of the year three, we will debit construction in progress, right? And then we were debiting two accounts, construction cost and crediting revenue. The construction cost of construction will be 4.1 million, which equals the number here. Remember, we talk about the total cost of this construction is 4.1 million. So this is almost equals the cost of goods sold account. Okay, like if you consider this is normally what we do, and a crediting revenue account. This is a revenue account, and then we're recording the profit of this project under construction in progress account, $900,000. Okay, and then if we're recognizing the revenue over a period, it means that we don't want to wait till 2023 to record this transaction. What do? We also periodically we record debit the profit of 500,000 and debit the construction cost for 1.5 million for the first year and crediting revenue for $2 million. I will talk about how did this 2 million calculate. How did you know your revenue can be recognized as 2 million in period 1, 1.125 million in period 2, and then you can decide the once you know the cost for sure, but you have a question about how do we recognize the revenue and the profit itself, right? under the construction in progress account is just gonna be the difference between revenue and the cost. And so therefore the key is to know that how did I know that the first year the revenue is 2 million, so the second year is 1.125 million, the third year is 1.875 million, right? Okay, but at least you can see no matter we are up on completion or over the time, they all add up as a $5 million as a revenue, which is the transaction price, right? Okay. So and then you, as you can see, no matter is based on this up on completion method, as you can see, I debit $900,000 under at the end of year 2023, right? That means that the construction in progress account will have a balance of 5 million in total, and the billing itself have a 5 million in total. So let's look at where is this coming from, right? And where this 900,000 come from. So the each of 1.5 in 2021 was based on this journal entry. Remember this journal entry? I call it the journal entry 1, right? Journal entry 1, you book in the CIP already 1.5, 1 million, 1.6. And the journal entry 2, you book the 9 million here, right? So therefore, this is a journal entry 1, journal entry, not the journal entry 1, it's just that journal entry that show up there, right? We know that it's a 3 journal entry because it's 3 years. And this is a journal entry 2, right? My journal entry 2. And then where's the 1.22 and the 1.8 coming from? And then this coming from this billing, right? Recorded the progress of billing transaction generation journal entry 3, 1.2, debit accounts receivable credit billing for 1.2, 2, and 1.8, right? So therefore, as you can see, it's a credit on this side. In other words, the CIP and the billing account is gonna be cancelled out in the end. They both, one have a debit side of 5 million and one have a credit side of 5 billion. But in each period, during each period, you can see if the cost is higher than the billing, that means that you have, remember, contract assets on the balance sheet, okay? But when in year 2, the billing, the construction cost of 250 is less than the billing, okay? This means that you have a contract liability on the balance sheet, okay? And in year end, it will be the same. So that's what something that is very new. And then you just need to remember this account. And this account is actually temporary, not a temporary account, it's a balance sheet account, but in the end, we're gonna close it, okay? But before that, I wanted to, another point that we wanted to know how to do is how did you recognize this 2 million as a periodically, when you periodically recognize the revenue, right? So this is a part that we need to talk about. So recognizing revenue over period of time according to percentage of completion, how do we do that? First of all, recognizing the revenue along the way, we call the revenue recognizing in this period. It equals total estimated revenue multiple, which is a $5 million, which is the total total revenue transaction price, multiple the percentage of completed to date. So and this we call the cumulative revenue to be recognized to date, and then minus the previous revenue being recognized, and then you can get the current period recognition. Okay. So same example. Remember the construction cost is 1.5 million. Construction incurred to prior period is 0. The actual cost is 1.5. The estimated remaining cost as at year end one, year one end is 2.2. So the total cost here is estimated plus actual is 3.75. So the contract price is 5 million, right? Transaction price is 5 million. So the percentage of completion is based on the cost completion of cost percentage. In other words, it means that actual cost happened, which is 1.5 million, dividing a total cost of 3.75. Okay, and this means the 40% of the product, 40% of the project has been completed. Hence, I multiply the transaction price. Then, therefore, I get $2 million. Okay, the complication comes in here. Okay, so second year, same thing. I have already actual cost to date is 2.5 million, and the total estimated plus actual is 4 million. So therefore, the percentage of completion is 62.5%. So multiple the consideration price. It should be cumulative revenue to recognize to date is 3.125. However, at the end of the year 22, you should use this one minus this to record the current period. Okay, so let's look at the second slide. So the cumulative revenue to be recognized to date on the year 2 is 3.125 million. But because you have already recognized this 2 million in prior period, therefore the revenue recognized in current period should only be 1.125 million. And then the third year is the same thing. Third year, you find that the cumulative recognized revenue should be 100%, 5 million. But in prior year, you have already recognized 3.125 million. Hence, this year, you only need to recognize 1.875 million. So the journal entry that you want to recognize over the periods, right, year by year, you wanted to debit cost CIP, but this only record the profits. And then so therefore, first of all, write down the revenue from long-term contract recognition, which is 2 million, and the real cost of that period, which is 1.51 and 1.6. So, right, and then the difference will be the construction in progress, which is the record each period's profits. Okay. And then, as you can see, the recognition becomes that construction costs, you recognize CIP. Instead of 900,000, remember there was a T account here. Instead of 900,000 at the end of on the completion, you recognize it in one journal entry. You recognize gradually, right? You recognize the 500,000 in the year 1 gross profit. You recognize 125 in year 2, right? And you recognize 275 in year 3, right? Instead of 900,000 at the same time. Okay. Okay. So therefore, this is more clear way. Revenue recognized 2 million, and the price is 1.5. So the gross profit is gonna be 500,000. The revenue recognized year to date is a 3.125 minus prior period is 1.125 minus the cost of construction 1 million. So therefore, it's 125,000. And year 3 is that the year to date revenue recognition is gonna be 5 million because you completed it, right? You completed, and the revenue recognized in prior period is actually 3.125, and then therefore the revenue recognized should in the current period should be 1.875 minus construction cost, and then the gross profit is 275. Okay, so after your job is done, remember we wanted to remove the contracts from the balance sheet, okay, by debiting the billing, crediting the CIP from entire value of the contract. So we want to get rid of these two accounts. So we debit billing and crediting construction costs. No matter you recognize the revenue upon completion or you recognize the revenue over the term of the contract. Okay. And the balance sheet recognition, as you remember, as we remember that if you choose a recognize upon completion, then you go to the T account here. Okay, you go to the T account here. You compare the CIP with the billing account. Let me highlight it. You see the end balance of year 1 is 1.5 on the debit side and the 1.2 on the credit side of these two accounts. So the leftover will be the debit side. So hence that is a contract asset, right? This is an asset. And then on the second period, your debit side is 2.5 million and the credit side is 3.2 million. That means you have a contract liability for 700,000. And on the third year, everything gonna be washed out then because you're gonna close it, right? So at least if you based on the completion, you can see this one is you're gonna be having a contract asset. You see that? We call that a contract asset for 300,000 and the contract liability for 700,000, right? But if you're choosing to recognize revenue over time, then you can see this T account. You can see that at the end of the year 1, still 2 million of asset and 1.2 of liability. That's gonna give us 800,000 as assets. And then at the year end 2 is a 3.12 as a construction in progress asset and 3.2 as a liability. That gives us 600. This will be $672,000 of liability, and then year 3 is gonna wash out because they're gonna catch up on each other. So therefore, you can see it on the asset and liability side, right? Year 1 is 800,000 on the asset, and year 2 is gonna be 75,000 on the credit liability, right? Okay. Okay, very good. So let's do a calculation here, okay? So Robertson Construction entered into a contract to construct a tunnel for a fixed price of $12 million. This is the transaction price, contractual price. Robertson recognized revenue over time, so it should be over time recognition. According to percentage of completion, here are some facts, okay? So therefore, first of all, year 2021, the cost incurred is 3 million, and the estimated additional cost to go is 6 million, okay? So therefore, the actual cost plus the total, the expected cost, estimated cost to go at year end should be $9 million, right? And year 2, the cost incurred is 5 million and the estimated additional cost to complete is 2 million. That means the total accumulated cost should be 3 million plus 5 million plus 2 million. It should be 10 million, right? Because this is already actually happened, total actual plus additional to go, so it's gonna be 10 million, right? And then the last one is gonna be actual, right? So 3 million plus 5 million plus 2.5 million is gonna be 10.5 million. So what I wanted to write this column is accumulated actual plus estimated costs, okay? That's trying to help us to calculate the percentage of completion, okay? So if the year 1, they're asking the Robertson's for completion percentage, how should we do it? Very good. We should just using the, for year 1, just use 3 dividing 3 plus 6, right? is going to be 3 divided 9 is going to be 33.3%. Should choose B. Okay, so this one is that same thing. It says, how about the year 2's completion? Year 2's completion is, remember we actually calculating year 2's total estimation cost. It should be 3 plus 5 dividing 10, right? So it's going to be 80%. Because the accumulated actual cost plus estimated additional estimation is going to be in year 2, okay? It's going to be 3 plus 5 plus 2, right? Going to be 10. So I'm just omitted the zeros, right? So we just be simpler. So it's going to be 80. Okay, the third one saying that what kind of revenue will be recognized in year 1. So remember the production transaction price is going to be 12 million, and we multiply the completion of the completion of the transaction, right? So for year 1, it's going to be 3 dividing 3 plus 6, right? And we know this is 33%, so therefore 12 multiple 3 over 9, right? 3 over 9 is going to be 4, right? So therefore we choose A. Okay, so remember last in year 2021 we recognized 4 million, okay? And then what would be recognized in year 2? 22. So first of all, the completion percentage is going to be 3 plus 5, right? Dividing 3 plus 5 plus 2. And we know that this is 80%. And 80% multiple transaction price of 12 million. So that's going to be 10.6 million, right? 10.6 million, this is as of today, as of end of period. It's going to be called cumulative completion, right? Completion for revenues. And we need to minus the things that we have already recognized, minus 4 million. They're going to give us 6.6 million. Oh, sorry, this should be 9.6, so that's going to give us a 5.6 million, so we will choose number B. Okay, for year 3, okay, so year 3, our completion percentage is going to be 100% complete, right? We will multiply $12 million as a transaction price, but what we will minus, remember, it was a totaled up to from 4 recognizing the first year, and then plus, remember, 5.6 for the second year recognized. This is going to be 9.6, and then they're going to be 12 minus 9.6. That means totally we can only recognizing 2.4 million, right? So that's going to be this one. Okay, so now I wanted to talk about, I believe it's quite a difficult part of this lecture. It's called recognizing long-term construction losses. And then there's two kind of construction losses that we will encounter. One is called a periodic loss, means like during the period we find that we might losing money, but in the end we still profitable. So occurs a project that is projected to be profitable overall, but there's a periodic loss. And there is one kind of loss called the overall loss, that is the project to occur for the entire period is lost. So basically after a couple years you know that I will never make money from this project. Okay, periodic loss means once cross the time that in the end you're still profitable, but there will be 1 or 2 period that you're losing money. That means that you got to control your cost, cut down your cost to catch up, right? And then either of these options, then the seller has to updating their estimate and recognizing losses as necessary, but specifically depending on the timing of revenue recognition. Okay, so let's look at this example. This is a periodic loss example. Okay, occurs for a profitable project. the revenue recognition is over time. So you still have a profitable project, but it just during the second period it started losing money, and then you choose to recognize revenue over time. What are you gonna do? In year one, everything still stay the same, but in year two, look at, in order to calculate completion percentage, you use the actual cost dividing the total estimated cost, or 4.6. So you find that the completion percentage is 60%. And then when you multiply the contractual price, which is 5 million, multiple 60%, it's actually $3 million. When $3 million minus the previous recognized revenue for 2 million, okay, then you know that this period you can recognize $1 million of revenue. But when you trying to debit the construction cost, which is 1.26 million, you're crediting the revenue recognition for 1 million. You find that debit does not equals credit, and then you will recognize the loss part of this year, okay, still park under CIP, but the CIP this time is a credit balance for 260,000, which is the difference between your revenue and your cost, okay. But if you same scenario, your periodical loss, which is second year, but the project still profitable in the end, okay, you still under control the budget, under the budget. And then how do you do if you want to recognize the revenue up on the completion of the project? That means that although you know that you're gonna losing money of $260,000, but because you're only recognizing everything at the end of period, so there's no journal entry that needed, okay? So the last thing we want to talk about is lose project, okay, on the entire project. So the entire thing has already lost money. For example, the first year everything's still the same, but on the second year you find out that your project in total is already way passing the transaction price, because the actual cost, adding the estimated cost to go, is way bigger than $5 million. So this means that you will lose the money for the whole project, okay? So the first year, as you remember, the first year we were still recognizing the revenue as what it should be, is 500,000. This didn't change. If you go, that's why when we talk about the long-term contract, I want you to remember every number. So yes, 2021 is still 500,000, but 2022, as you can see that we're already losing money for $100,000, right? Why is that? Because the $5 million minus 5.1 million equals $100,000, right? So this $100,000 means that our profit is a minus $100,000, and we know that we have recognized $500,000 of profit. So what is the number that the profit that or loss we have to incur to knock down, reduce $500,000 not to zero, and also incur extra 100,000? That means the loss is actually $600,000, okay? And the year two, that we know that we have a total loss of 5 million minus 5.2 million, right? The total cost is 5.2 million, so that means we lose $200,000. So we have recognized so we know that we totally we're gonna lose 200,000, and we have recognized 100,000 already as of date, right? And then what is the question mark? The question mark is only gonna be 100,000, right? Because of 500,000 minus $600,000 is negative 100,000, and then minus another 100,000 is gonna be 200,000. Okay, so this is the over the period what our revenue recognition gonna be look like, right? And profit and losses recognized, and then if we're up on completion, right? So that means that we just needed to take care of this one. But we needed to updating the loss accordingly, because this sentence saying that we have to always seller must update their estimating and recognize losses as necessary, no matter you are using the upon completion method or over the period method, right? Okay. So the year 2022, we need to recognize loss of 100,000, and year 2023, we also need to recognize loss of 100,000. Okay. So let's first look at how to recognize revenue of a loss project over the period. So first of all, the revenue recognized for the first period is 200,000, which we already talked about. This number equals 1,500,000, right? Dividing 3,750 multiple 500,000, 5 million. Right, the completion dividing total and the multiple the construction prices is gonna be the transaction price is gonna be the revenue recognized, and then minus the right, and you will recognize the minus the construction cost. So therefore, you have gross profit of 500,000. And second year, you say that you actual total cost year to date is 2.75, and dividing the estimation of 5.1, you have completed a 54%, and then multiple 5%, 5 million, you get that the revenue recognition to date is 2.706, and minus the revenue recognized is 2 million. You know that revenue recognized for the current period should be 706. And you know that you have already incurred a loss of 600,000 to make sure that this, because 600,000 equals minus 100,000 minus 500,000, right? So this number, the revenue recognized number is backed out from 600,000 minus this number. Okay. In other words, the cost of construction, this number, is determined after you know the revenue number recognition and the profit or loss, the loss, you back it out. Okay. So, and then year 3, that you know that you have to have a loss of 100,000, and then you're calculating the revenue of 2.295, and then you back out that construction cost is 2.394, and then when you recognize over time for year 2, you of course you debit the construction cost of 113, right? This is cost. You debit the construction cost and you credit in revenue from the long-term contract, which is this one, and then you put the CIP, which is loss, on the credit side for 600,000. Okay, and then also you debit the construction price, which is the back out number, this one, on the debit side, and you credit in the revenue recognized, which is this number, right? And then you credit in the loss. Okay, so if you the whole project you lost, but you recognize the revenue upon completion, so you just needed to do you still need to do 2 journal entry on year 2 and year 3. So in other words, when a contract does not qualify recognizing revenue over time, means that you recognize revenue upon project completion, and then no revenue or cost construction is recognized until the contract is completed. So anything related to the cost of construction and revenue of the contracts is recognized at the end of the construction. contract. So you know that the construction cost is the loss itself is 100,000, and the revenue is definitely the transaction price of 5 million, and then your cost of construction is backed out from this. You're adding these two together on the debit side, right? So this is costs. But on the year 2, don't forget that you have to updating this loss of 100,000 timely. So therefore, your construction in completion, this loss is recognized in year end 2 as well, credit 100,000, and you're debiting the loss account for 100,000. Okay. Okay. So this is the whole chapter 6, and I know it's pretty challenging. But I think when we learning the class, I will show you guys a lot of exercise. I hope that's gonna help. And by the way, I know that some of you guys are downloading the in-class exercise slides from the publisher. And when I ask you guys questions, you directly read the PowerPoint to me. What I suggest you do is that it's not bad that you learn, right? And you wanted to answer the correct answer. But I would like you to do this. First of all, you can review that slides before the class, okay? But when the class comes, I want you to follow my steps to answer my question. That way, you get the exercise together and stimulating your memorization and the practice ability of how do you understand the question. Okay, that's just the things that I can't talk. I didn't want to say in the class, you know, but I just wanted, if you guys watch this video, I hope you guys can follow my instruction. Okay, so in nutshell, I think this chapter talk about part 1, part 2, and part 3, right? Part 1 is basically generally to recognizing a revenue at a point of time and or over a period of time, right? And then in chapter 2, part B is actually talk about considerations, which is the special issues. Okay, how about I just say special issues? It's including consideration, financing components, and seller rebate the customers. And part C is to talk about the long-term contracts. And all these things is actually governed by 5 steps, right? So we talk about the recognition of the contracts and identify the obligation and transaction price, allocation of transaction price, and recognizing revenue, right? In the part B, we talk about special issue of step 3. How do we recognizing the transaction price, and a lot of issue in the step 5, which is consignment, franchise, right? And consignment and buy and hold and stuff like that. And then step 3, we talk about different way to recognizing transaction price, right? And part A is pretty much in general. And part C is interesting because everything we wanted to depend on percentage of completion. And we introducing 2 accounts. One is called CIP, construction in project. It's an asset account. And also another one called the billing of the process construction, right? And then we say that these 2 accounts gonna record the asset of the project and liability of the project, and then in the end we wanted to close them out. So this is one difficulty. This is difficulty 1 for the part C. Difficulty 2 is to understanding how do we use this, right? And then we say that the CIP usually contain the costs plus the profits of the project, right? And the billing of the construction process is gonna record the revenue. Basically, is debiting accounts receivable and crediting billing, right? Okay. So I think we can do a lot with this chapter, and I can assure you that A and B is going to be heavily tested. C, I'm trying to testing some of the calculation of completion of the revenue and the how do we do over the time recognition of the profits. But I will make sure that the difficulty level is adjusted. I appreciate you follow me along, and let's tackle this chapter together. Thank you.